It is a question that refuses to die. Is gold still a safe haven? For centuries, gold has been seen as the ultimate store of value, a hedge against inflation, geopolitical risk, and monetary debasement. And yet, in recent years, some voices have argued that its luster has dulled. They point to newer alternatives, increased volatility, shifting correlations with equities, and occasional sell-offs during crises. They ask, has gold become just another asset, stripped of its protective qualities? Let's find out. Today, we put the debate of whether or not gold is a safe haven to bed. And we will explore not just whether gold acts as a safe haven, but what that term even means in the current economic context. And stay with us, because later in this video, we will walk through the 5 enduring reasons why gold does still hold its status as the ultimate safe haven, from its unparalleled role in economic stability to its unmatched liquidity and historical significance. We will break down precisely why gold remains the linchpin for wealth preservation in an unpredictable world. If you have ever wondered why investors from central banks to private citizens keep turning back to gold, then you do not want to miss that section. But first, we have to ask, if gold isn't a safe haven, then what even is a safe haven? Much of the debate around gold's safe haven status hinges on a narrow and frankly outdated definition, because traditional finance academics often define a safe haven as an asset that maintains a negative or near zero correlation with riskier assets, such as equities, during periods of market stress. But by this definition, gold does sometimes disappoint. Because during certain crises, gold has moved in tandem with stocks. The COVID-19 crash in March 2020 is frequently cited. Equities collapsed and gold sold off alongside them. And critics argue that this proves gold's failure as a safe haven. But this interpretation is too simplistic. It ignores liquidity dynamics and the role of gold as a monetary asset. In market panics, investors sell whatever is liquid to meet margin calls and cover losses elsewhere. And gold is uniquely liquid and universally accepted, which means that it's often sold first, not because it has failed, but because it works. And indeed, gold's role is not to deliver short-term gains during every crisis. It exists as a monetary firewall, preserving purchasing power over the long term and serving as a last resort collateral in moments of systemic stress. Every so often, a new piece of research or a high-profile speech emerges arguing that gold has somehow lost its long-cherished status as a safe haven. And a recent example of this comes from a paper that was published in the Global Finance Journal. In this study, the authors have presented an array of detailed data and analysis examining gold's short-term volatility, its occasional positive correlation with equities, and its seemingly inconsistent behavior during moments of crisis. But their research, whilst undeniably thorough, has seen them asking the wrong questions, and this leads them to fundamentally flawed conclusions. At the heart of this debate lies a crucial question: what exactly is a safe haven? If we define it strictly, seeing it as always as an asset that must always rise precisely at the moment that equities fall, then yes, gold does not consistently meet that standard. But this narrow definition says far more about the short-sightedness of modern finance than it does about gold itself. Gold has never been merely a quarterly hedge. Its role is far more profound and in many ways far more subversive. Throughout history, gold has served as far more than a store of value. It has been a potent symbol of financial dissent. Whether we're talking empires, dynasties, modern states, it has stood as a hedge against inflation, a shield against the erosion of purchasing power, and a bulwark against centralized monetary control. Owning gold is not necessarily a vote for returns in the traditional sense. Rather, it's a vote for independence from monetary experiments or rascal fiscal policies and the shifting sands of fiat currency regimes. In a world increasingly defined by monetary manipulation, that distinction has never been more relevant. We are living through a financial era marked by extremes: excessive debt accumulation, unprecedented leverage, and relentless intervention by central banks and policymakers. Years of unconventional monetary policy have turned market volatility into a recurring feature rather than an anomaly. And tools like zero interest rates, negative yields, and quantitative easing have fundamentally altered the financial landscape. And in such a distorted environment, it is hardly surprising that gold's price movements would appear more turbulent. But mistaking this turbulence for failure is a fundamental misunderstanding of gold's purpose. The volatility in gold's price is not a symptom of its irrelevance. It is a mirror held up to the escalating instability in the world around it. Now, academic models frequently overlook this crucial truth. What they are failing to grasp, and what seasoned investors increasingly understand, is that gold is not a bet on the market. It is, in essence, a bet against it. This is not a radical position. On the contrary, I'd say it's deeply conservative. It's grounded in prudence, caution, and historical wisdom. Gold invites its holders to think not in terms of days, weeks, or fiscal quarters, but in decades or even lifetimes. It exists entirely outside of this sprawling digital financial system. It is immune to the decisions of policymakers, the influence of speculative capital, or the algorithms that drive this high-frequency trading we see. Now, to some, this makes gold seem outdated, an archaic relic of bygone era. And to others, it makes gold not only relevant, but essential. The famed economist Friedrich Hayek, writing in the 1940s, warned of the dangers inherent in monetary centralization. He spoke of the fatal conceit, the dangerous arrogance of those who believe that they can fine-tune complex economies from above. Today, we are witnessing the full consequences of that conceit. Years of monetary experimentation, artificially low interest rates, negative yielding bonds, and vast quantitative easing programs have warned and warped markets. They have distorted prices and vastly inflated both private and sovereign debt. So it's hardly surprising then that gold has re-emerged as a meaningful strategic asset. And this revival is not limited to individual investors, because as we all know on this channel, it includes central banks themselves. Across emerging markets and advanced economies alike, central banks have been quietly accumulating gold. They are diversifying reserves away from the US dollar and other fiat currencies, and not as a matter of speculation, but as a strategic move to insulate themselves from the risks of a fracturing global financial order. And here lies the great irony. While many financial commenters loudly declare that gold is an outdated relic, the world's central banks, those ultimate insiders with unparalleled access to information and influence, they are the ones quietly accumulating the gold at record levels. Why? Because they understand something fundamental and timeless. Gold is no one else's liability. It does not require a counterparty. It is immune to the risks that plague most financial assets, including sanctions, capital controls, default, or digital erasure. For individual investors, this should serve as a powerful signal. In an era when even the most sophisticated institutions are turning back to gold, the case for individual allocation becomes even more compelling. So very quickly, why does gold remain the ultimate safe haven? Well, here are my 5 core reasons why gold continues to hold its status as the ultimate safe haven. First up, you've got economic stability and trust. Gold has outlasted every fiat currency in history. Its resilience through wars, depression, monetary crises, that makes it an unparalleled store of value. It has served as money for thousands of years, trusted in every corner of the globe. And what about inflation protection? Gold consistently preserves purchasing power over time. And while it may not track inflation perfectly in every short-term cycle, its long-term role as a hedge against monetary debasement is well documented. It shines brightest during prolonged inflationary periods and monetary regime shifts. It has real diversification power. Gold tends to perform well when other assets struggle, and this makes it a valuable portfolio stabilizer, reducing overall risk. It shows crisis resilience and liquidity. As gold's liquidity is unmatched among alternative assets, it can be sold virtually anywhere, anytime, without significant price concessions. And in times of severe market stress, this liquidity makes gold an indispensable asset. There is universal demand and geopolitical neutrality. Unlike other assets that rely on financial systems or governments, gold is tangible. It's a globally recognized asset with universal demand. Central banks, institutions, and individuals across every continent continue to accumulate gold as a neutral reserve, immune from political manipulation. And for me, together, these 5 characteristics explain why gold remains a safe haven asset like no other. It does not simply protect against volatility, it guards against monetary failure, systemic collapse, and geopolitical rupture. In conclusion, I would argue that gold is anti-fragile. The philosopher Nassim Taleb has explored this concept extensively, writing about anti-fragility. An anti-fragile entity is not merely able to survive shocks, it can thrive because of them. Gold, in its quiet and unassuming way, is profoundly anti-fragile. It has weathered wars, revolutions, collapses, and countless financial crises. Gold's value is not rooted in fleeting market correlations or speculative bubbles, but instead over 5,000 years of enduring human trust. Holding gold is not about forecasting imminent disaster or timing market downturns with precision. It is about acknowledging the inherent limits of prediction itself. In this era of rising complexity, fragility, and financial uncertainty, that may well be the most rational and quietly powerful position one can take. So investing in gold is not an act of pessimism. It is an expression of humility. It's a recognition that no investor, policymaker, or algorithm can fully foresee the storms that may lie ahead. Gold investment to me, above all, is an act of prudence. And if you're looking to get prudent, and if you're looking for the exit, why not click on the link below and download one of our guides today?